Do you ever wonder where to start when it comes to investing in stocks? It can seem like gambling to some, and it can feel pretty overwhelming. And I get it. I felt that way until I learned how to navigate stocks and how to use different classes of stocks to my advantage. They all have different goals, and depending on what your goals are, there is a strategy for you. I'm going to do something many people said not to. I'm going to go through my current portfolio and show you how and why I'm investing the way I do. Now, this isn't advice or something you just blindly follow. I'm trying to make investing in stocks more approachable and to help you create your own plan and strategy for your investing. I'll be launching a new video per week, so make sure you're subscribed so you can follow along. What's up, world? Rico here. Today we're doing something a little bit different. Instead of focusing on one ETF or one stock, I'm comparing 4 key Vanguard ETFs in my portfolio: VGT, VOO, VTI, and VTV. They each play a unique role in my investing strategy. And be sure to stay until the end of this video where I'll share my holdings, how they stack up, and why I've allocated them the way I have. Spoiler alert, these stocks aren't get-rich-quick stocks. None really are, and if that's your goal, stocks and ETFs might not be the best for you. That being said, let's get into it. So, first off, let's just start with the basics. What are these? So VGT, this is the Vanguard Information Technology ETF, and it focuses on the tech sector, tracking the MSCI US Investable Market Information Technology 2550 Index. We'll get more into this later. Basically, it follows the tech sector, NASDAQ, and you can see in the graphic below what industries it's in. Next is VOO. This is the Vanguard S&P 500 ETF, and like it says, this mirrors the S&P 500 index. This gives you exposure to 500 of the largest US companies across all sectors. Next is VTI, the Vanguard Total Stock Market ETF. Like it says, it's a broad market ETF that tracks the CRSP US Total Market Index, covering large, mid, small, and micro cap stocks. It's basically investing in the entire US stock market. And then finally, there's VTV, the Vanguard Value ETF, which focuses on value stocks, tracking the CRSP US Large Cap Value Index. These are companies with strong fundamentals that might be undervalued by the market. All right, let's talk about the performance. When it comes to these ETFs, they have very different profiles. So far, VGT has been the star performer with a 10-year annualized return of about 21.2%. And it's a growth powerhouse, but comes with higher volatility. There have definitely been some ups and downs, but so far year to date, as of this recording, VGT is up a whopping 30.81%. No matter what people feel about the economy, stocks and investing has been booming over the last year. This has been thanks to the booms in AI and crypto. Next, we'll get into VOO, and this has delivered a strong and steady 10-year annualized return of about 12.3% over the last 10 years. It's the classic set it and forget it ETF. VOO also had a great year, not as strong as VGT, but still had year-to-date returns of 27.21% as of this recording. Another great growth engine because of some of the tech holdings, but since it isn't as focused as VGT, growth was a little bit more moderate. All right, VTI, this closely mirrors VOO with a 10-year annualized return of around 12.1%. The added exposure to small and mid-cap stocks hasn't made a huge difference historically. That being said, VTI has had a great year and is very similar to VOO's year-to-date returns. VTI grew 26.59% this year. And then finally, VTV, which focuses on value, which has underperformed growth recently. Its 10-year annualized return sits around 9.6%, but value tends to shine in different economic cycles. Now, 10% growth over that time period isn't terrible, but remember, this tracks value stocks, so it's the most conservative of these ETFs. So far this year, VTV has returned 18.01% as of this recording. Not bad, but definitely lags the other 3. Next, let's talk about dividends and how much of these ETFs you'd need to create a $50,000 annual income simply from their dividends. These are going to be some pretty big numbers. If you've seen some of my BDC at REITs and other ETFs, these numbers are going to be much bigger. Okay, so VGT's dividend yield currently sits at around 0.6%. Not a great choice if income is your goal. With so much growth in the stock price, the dividend will continue to feel smaller because the ratio will continue to change. To generate an income of $50,000 a year from VGT dividends, you'd need to have roughly $8.3 million invested in this ETF. I'm not sure you have that laying around. I don't, for sure. Now, VOO's dividend yield is sitting around 1.22%, offering a bit more for dividend seekers, but still not that great of an option if you're looking to retire relatively early. You'd need around $4.2 million invested in VOO to create a $50,000 a year income from dividends. VTI is not that much different. Their yield is about 1.25%, so very similar to VOO due to many of the overlapping holdings. Again, with this ETF, you're going to need around 4.2 million to create that $50,000 of annual dividend income. And then finally, VTV is a standout here with a yield of around 2.18%, which is solid for a value-focused ETF. This will be easier to generate $50,000, but it will still take a significant amount of capital. A cool 2.4 million will get you to the goal of $50,000 per year. So as you can see, none of these are great options for income investors unless you're a very high earner, you were or are a very high earner, and you have lots of years of investing left. These ETFs can definitely work for those types of investors. I'd love to hear your thoughts. Comment down below. How are you using these stocks? And what is your preferred strategy? Growth, income, or both? Okay, so who are these ETFs for? Each of these ETFs appeal to a different type of investor. VGT, pretty straightforward. These are your growth-focused investors who believe in tech and don't mind some volatility. That's me to some degree. VOO is a great all-around option for anyone looking for steady growth and low costs. This is going to be your steady Eddie, S&P 500. It's great. VTI works well for those who want broad market exposure, including small and mid caps. So it's like VOO, but it's expanded across even more of the market. And then VTV is for investors looking for stability and dividends with a tilt towards undervalued companies. Should be more steady, but again, then you won't have the more of the growth. It's almost a risk reward. So remember that these are all long-term investments and are more focused on growth instead of income. I'm using these ETFs not to generate income, but to provide me with steady or even exponential growth that I can later move into higher yield investments once I'm ready to retire. We'll get to those stocks later in this series, so definitely stay tuned for that. Subscribe if you haven't already so you get notified. Okay, really quickly, we'll just go over some quick pros and cons for these, just so we stay organized. Let's break it down. You may have already heard these. You can get these down from the rest of the video, but I wanted to put it all in one place. Right, so VGT, pros, high growth, tech focused. Cons, higher volatility, really low dividends. VOO, more diversification and steady returns, limited small and mid cap exposure. These are mostly the top 500 biggest companies, right? Because it indexes the S&P 500. Okay, VTI, pros, broad market coverage and then low costs. But the cons, it's similar to VOO, so you might actually get more value out of VOO. You may not need to be invested in both. And then VTV, higher dividends, relatively speaking, and less volatile than the other growth ETFs like VOO and VGT. The cons, it's slower growth and value has lagged in recent years. So if you have a long time, steady Eddie, you can go with VTV. So future outlook. Now looking ahead, I see each of these ETFs playing a role depending on the market conditions. VGT has massive potential as tech continues to dominate with AI on the rise and innovation moving at an exponential pace. But it'll be sensitive to downturns, and since it's all concentrated in one sector, tech, these downturns can be big, and you want to make sure you're monitoring the market with something like VGT. VOO will likely remain a solid choice for consistent long-term growth because of its diversification, but concentration in high-value large cap corporations can be limiting for some people. I will say VOO, it's very low risk and it's banking on the top 500 businesses in the US. So unless you think those will all go out of business one day, VOO is a pretty good investment. Remember, this isn't advice, just my opinion. Okay, VTI offers the broadest diversification because of the small mid, which could help in certain markets. More mid cap investments rolled in, this is exposure to so many more industries and is spread across more businesses. It's like having investments in everything as opposed to just the big guys. So if you want to go back to the gambling analogy, it's like putting chips on everything. So you will win something, may not be big, but you will not lose as much as the others. And then VTV might come back into favor if value stocks begin to outperform, especially in a rising interest rate environment. I may reconsider growing my position here simply because I value growth and VTI will have more of that covered for me. So I don't know if I'm going to continue to grow my portfolio in VTV. Just my 2 cents. Okay, so here now is how I'm allocated and how these ETFs fit into my portfolio. So VGT makes up 10.9% of my portfolio, roughly. It's my largest holding of these because I'm bullish on tech and long-term growth. I have a strong tech background. It's what I did for 20 years, and the world is constantly evolving, innovating. AI is here to stay, whether we like it or not. And we've seen more innovation in the last 100 years than in the entirety of the human history before that. So tech definitely is here to stay. VOO is roughly 8.2% of my portfolio, giving me solid exposure to the broader market. This helps me diversify more. VOO, as we talked about, tracks the S&P 500, which has stock from almost every sector of business, and it's all the best performing ones. VTI sits at about 1.9% of my portfolio, adding diversification across the entire US stock market. This takes VOO a bit farther, helps me continue to diversify and exposes me to small and mid-cap stocks that aren't part of the NASDAQ or S&P 500. And then VTV rounds it out at about 1.8%, focusing on value stocks to balance the growth tilt in my portfolio. It's steady and low risk. It's great balance, but like I said earlier, I may actually convert these into one of the other ETFs or move it into something that generates more income and more growth. That's how these 4 Vanguard ETFs compare and fit into my portfolio. Each one serves a purpose, from high growth tech exposure to steady market performance and value tilt for balance. What about you? Are you holding any of these ETFs, or do you have favorites that I should look at? Let me know in the comments below, and don't forget to like and subscribe and share if this helped you out. So keep building a portfolio that works for you. We all have different goals, and there's always a way to achieve it. Remember, if it doesn't challenge you, it doesn't change you. Thanks for watching. Take care. I'll see you next time. Boom.